Yet again, another IPO opens for subscription, which goes by the name Appejay Sureendra Park Hotels Limited IPO. In this video, we will discuss the IPO details of Park Hotels, the business model and the industry it operates in, followed by the financials of the company, peer analysis and lastly the valuation. Let's look at the IPO details first. The IPO opens for subscription today and closes on 7 February 2024. It has fixed the price band at 147 to 155 rupees per share. So for a retail investor, the minimum lot size would be 96 shares, translating to a minimum investment of 14,880 rupees. Park Hotels plans to raise 920 crores from the public, out of which a majority or 65% of the issue would be a fresh issue of 600 crores, while the remaining 320 crores will be an offer for sale, which means the existing promoters or shareholders are selling off their shares. Post the IPO, the promoter shareholding will drop from 94.18% to 68.13%. The IPO has the following reservations: 53.4% for qualified institutional buyers, followed by 26.7% for non-institutional buyers or HNIs, and lastly, the retail quota of 17.8%. Employees of Park Hotels have been reserved a quota of 2%. So what are the objectives of the issue? The primary reasons for the IPO are to raise funds towards firstly repayment or prepayment of borrowings, secondly for general corporate purposes. Before we get into the details, let's understand the business model of Appejay Sureendra Park Hotels Limited. As the name suggests, Park Hotels is engaged in the hospitality business, operating under the brand names of The Park Collection, Zone by the Park, Zone Connect by the Park and Stop by Zone. Additionally, they have established a presence in the retail food and beverage industry through their retail brand Flurries. They operate in about 30 hotels in 20 cities across India, with 2,298 rooms, making them the 8th largest operator in India in terms of chain affiliated hotel room inventory. In context, out of the 30 hotels owned, 7 hotels are directly owned, contributing a major chunk of revenue, about 85%. 3 hotels are leased for long term, generating 4.5% of the revenue as of fiscal year 23, and lastly 20 hotels are managed by the management team, generating 1.72% of the revenue breakup. The hospitality sector in India consists of hotels offering rooms to tourists and business travelers, both domestic and international, along with restaurants, bars, banquet facilities for events. As you guys are aware, they are categorized into 5-star, which includes luxury and upper scale hotels, followed by deluxe and luxury hotels, which are referred to as 4-star. Lastly, upscale hotels are referred to as 3-star hotels. The rapid growth in India's hospitality industry is expected at an overall supply of CAGR of 8.6% from September 2023 to fiscal year 27 across all segments. Now coming to the financials, after a dip in sales during the COVID outbreak, the company recovered and the revenue grew at a CAGR of 40.2% from fiscal year 21 to fiscal year 23. As of 30th September 2023, the company reported a revenue of 272.3 crores. When looked at the EBITDA margins, the company witnessed healthy margins around the 30% mark. Now when we look at the bottom line, after witnessing losses in fiscal year 21 and fiscal year 22, post the COVID recovery, the company turned profitable in fiscal year 23 with 48 crores of profit. In the first 6 months of the fiscal year ended, it reported 22.9 crores of profit. Since the company employs a substantial amount of borrowings, the financing costs were reported at 62 crores as of fiscal year 23. However, the debt to equity has been around the 1% mark. In hotel specific metrics, the company reported an average room rent of 6,000 rupees in fiscal year 23 and in the run up to September 2023. Interestingly, even the average occupancy saw healthy numbers at around the 90% mark for the same period. Among the peers, Park Hotels has the highest occupancy ratio, indicating most efficient utilization of the existing assets. In terms of revenues, Park Hotels is the smallest player. When it comes to EBITDA profitability and return on capital employed, it stands as the 3rd position after Chalet and Lemon Tree Hotels. It also has one of the lowest debt to equity ratios. When looked at the valuation of the company as compared to its peers, with an upper price band of Rs 155 and EPS of 2.75 as of fiscal year 23, the company trades at a P ratio of 56.4 times, which is relatively lower than its peers with the industry average as 73.6 times. Moving on to our last segment, which is the strength and weaknesses. Let's start with the strengths. From the proceeds of the IPO, they will pay off their 550 crore of borrowing out of the 597 crores, thereby reducing the debt element drastically. After witnessing subdued growth in the last few years, the hospitality industry is likely to witness an upside. The company enjoys a high occupancy rate and healthy room rate, translating into a good revenue per available room. Apart from hotels, it also has F&B and entertainment contribution, which adds to the stable and non-cyclical earnings. Now let's talk about the weaknesses. The company has risks associated with the delay in development of hotel properties and land banks. A higher concentration of revenue comes in from the top 5 directly owned hotels. The third weakness is that a few hotels are mortgaged with lenders, with the title deeds of certain immovable properties not held in the company's name. Lastly, it operates in an industry with high working capital requirements. Having said that, this is me, Ralasan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment related documents carefully. Visit www.researchandranking.com